In this video, we're going to discuss and record basic leasing transactions. A lease is a contractual agreement between a lessor and a lessee that gives the lessee the right to use specific property owned by the lessor for a specified period of time. There are two broad types of leases: financing leases and operating leases. For lessors, financing leases are often referred to as sales-type leases. Some of the special issues you're going to want to pay attention to as they relate to leases are the residual values of the leased property, other lease adjustments, bargain purchase options, short-term leases, and then presentation and disclosure of leases. These will not be covered specifically, or at least certainly not in detail, in this video. There are advantages of leasing for the lessee. It can provide 100% financing at fixed rate. It protects the lessee against obsolescence of property because the property returns to the lessor at the end of the lease. It gives them more flexibility, and it's often a less costly means of financing because of the security offered by the underlying property. For the lessor, there's often advantages also. It can provide profitable interest margins. It can help them stimulate sale of their products. And there are often tax benefits to the various parties involved in a lease. Be sure you understand some of the advantages and disadvantages of leasing to both the lessor and the lessee. From a conceptual perspective, a lease conveys the use of an asset from one party, the owner, the lessor, to another party, the lessee, without actually transferring ownership. There are various views on the capitalization of leases, and recall capitalization means record as an asset. One view is not to record any leased assets. A second view is to capitalize leases that are similar to installment purchases. A third view would be capitalize all long-term leases. And a fourth view, capitalize firm leases where there's a penalty for non-performance is very substantial. Under GAAP, we classify leases into two broad types: finance leases and operating leases. In either case, companies capitalize all leased assets and liabilities. And again, capitalize means record on the balance sheet. For a financing lease, the lessee will recognize interest expense on the lease liability over the life of the lease using an effective interest method. In other words, we're simply treating the lease as a different type of financing, and we would record interest expense on a loan, and we'll record interest expense on a finance lease. At the same time, they record the asset on their financial statements, and they would depreciate equipment. In this case, they will record amortization expense of the rights of use assets that they record on their books, and generally it's done so on a straight line basis. So again, for a financing lease, the lessee records both interest expense and amortization expense of the rights of use asset. For an operating lease, the lessee also measures interest expense and records interest expense on the leased asset using the effective interest method. However, the lease amortizes the right of use assets, in other words, records that depreciation expense on the property, so that the total lease expense is the same from period to period. So the lease expense will equal the payment that the lessee is making to the lessor. And a single amount, lease expense, is recognized on the income statement. It's comprised both of the interest on the liability and the amortization of the rights of use asset. So on the income statement, the lessee records a single amount called lease expense that doesn't change over time. On the balance sheet, the lessee will record a decreasing balance on the lease liability as it amortizes it, and a decreasing net asset related to the rights of use asset. We'll see that as we go through examples. Lessors also classify leases as financing or operating leases. The lease classification tests for the lessor are going to be identical to the test used by the lessee to determine whether the classification of the lease is a financing or an operating lease. For lessors, a financing, or often referred to as a sales type lease, the lessor has in essence sold or transferred control of the asset to the lessee. If the lease doesn't transfer control of the asset over the lease term, the lessor will generally use an operating approach in accounting for the lease. Again, for a financing or sales type lease, the lessee generally accounts for the lease as an asset sale. The lessor records a sale and a lease receivable and removes the leased assets from its books and records cost of goods sold. This is like the typical entry we would have for making a sale in any environment. The lease receivable will equal the present value of rental payments plus the present value of any guaranteed or unguaranteed residual values at the end of the lease term. The lessor will recognize interest revenue on the lease using an effective interest method over the term of the lease. For an operating lease, the lessor records lease revenue equal to the lease payment each period as the performance obligation is satisfied. If we receive any prepaid amounts, they're reported as unearned revenue, and of course, reported as earned revenue as the performance obligations are satisfied. And the lessor will also depreciate the asset on its book, recording depreciation expense and accumulated depreciation on the rights of use asset. Let's look at the classification criteria for determining whether a lease is a finance lease. A finance lease must be non-cancelable, and it must meet at least one of the following tests: a transfer of ownership test, a purchase option test, a lease term test, a present value test, and an alternative use test. So again, it must be non-cancelable and meet at least one of these 5 tests. If there's a transfer of ownership of the asset, then it's a finance lease. In essence, the lessor has sold the asset to the lessee, and the lease is simply a means of financing that purchase. The second test is a purchase option test. The lease might not transfer ownership of the asset at the beginning of the lease, but if it includes a bargain purchase option, in other words, the lessee can purchase the property for a price that's significantly lower than the underlying asset's expected fair market value at the end of the lease, we refer to that as a bargain purchase option. And again, it's essentially a sale. It's just the transfer is not happening until the end of the lease term. The third test is a lease term test. If the lease term is 75% or greater than the economic life of the leased asset, then it's considered a financing lease. In other words, the lease is long enough that essentially the lessee purchased the asset. It has use of the asset for most of the asset's useful economic life. Any bargain renewal options that extend the lease life are included in the initial lease term for evaluating this test. The next test is a present value test. If the present value of all the future minimum lease payments, those are the periodic payments and any residuals at the end, are greater than 90% of the asset's fair market value, well, in that case, the lessee is essentially buying the asset, and we will treat that as a financing lease. And again, lease payments will include fixed payments, variable payments, guaranteed residuals, any cash payments from the lessee to the lessor. Again, the thought is you've really purchased the asset, and this is just a means of financing that purchase price. In applying the present value test, we use the implicit or imputed interest rate within the lease. And if that's impractical to determine, well, then we'll use the lessee's incremental borrowing rate. The last step or test to determine whether something's a financing lease is the alternate use test. If at the end of the lease term, the lessor does not have an alternative use for the asset, in other words, what's the lessor going to do with it at the end of the lease? Well, then the lessee classifies the lease as a financing lease. In this case, the assumption is that the lessee has used all the benefits from the leased asset because the lessor has nothing to do with it. Therefore, they've essentially purchased that asset. So again, to summarize, a lease is considered a finance lease if it's non-cancelable and meets any of the 5 lease tests. There's a transfer of ownership, a bargain purchase option, the lease term is greater than 75% of the economic life of the asset, the present value of lease payments is greater than 90% of the fair market value of assets, or there's no alternative use for the property. Let's walk through an example of a financing lease from the lessee's perspective. Sunland Warehouse Corporation recorded a rights of use asset for $240,000 as a result of a finance lease on December 31, 2019. Sunland's warehouse incremental borrowing rate is 7%, and the implicit rate of the lessor was not known at the commencement of the lease. Sunland made the first payment of $54,704 on December 31, 2019, upon the signing of the lease. The lease requires 5 annual payments. The equipment has a useful life of 5 years with no residual value. This is clearly a capital lease because the asset has a useful life of 5 years, and the lease term is for 5 years, which is greater than 75% of the useful life. The first thing we're going to do is prepare an amortization table to calculate the interest expense and the change in principal on the financing lease obligation. We're told the implicit rate 7%, and we had a $240,000 balance, making 5 payments of $54,704 per year for 5 years, with the first one at time 0. In preparing our amortization table, the interest expense at time 0 is 0 because we haven't borrowed the money for any length of time. The change in principal then upon the signing of the lease will be $54,704, giving us a balance due at that point in time of $185,296. Interest at the end of the first year will be $12,971. That's the 7% interest rate multiplied by $185,296. The difference between our payment and our interest goes to principal and reduces the loan balance. And we would continue on through our amortization table. Again, at the signing of the lease, Sunland will record a rights of use asset as well as a lease liability equal to the present value of all those future lease payments, which was determined to be $240,000. It was also making a payment at time 0 of $54,704, which reduces our lease liability. Let's go ahead now and take a look at Sunland's journal entries for 2020, the following year. First, December 31st, we're going to have to record accrued interest expense of $12,971. That's directly from our amortization table. We will also then increase our lease liability because we're not making a payment of this interest until January 1. So our year-end interest accrual will always increase our lease liability, and that will of course be reduced when we make our payment on January 1. We're also going to record amortization expense on our lease. We're going to amortize the rights of use asset over the 5-year lease life, and we're going to record $48,000 in amortization expense each year over the life of the lease. When we make our lease payment on January 1, 2021, we will reduce our lease liability, reduce cash by the amount of the payment. Every time we make a payment on our lease, we reduce the liability by the amount of the payment. The date of that payment should have been 12/31/2020, not January 1. We could have also considered making a combined entry on December 31st, 2020. We would have had our interest expense of $12,971. We had our cash of $54,704. We had a net change to our lease liability of $41,734. That's our $54,704 debit to lease liability, less the $12,971 credit to our lease liability. And of course, last of all, we would have picked up our amortization of our rights of use asset. Let's look at the same transaction from the lessor's perspective. We've got all of the same information, but we're going to assume that the equipment had a cost to the lessor of $220,000. We've got the same implicit interest rate, and we have the same amortization table for the lease obligation. Upon recording the lease, the lessor will record a sales revenue of $240,000. That's equal to the present value of all the future lease payments. It also records a lease receivable of $240,000. And again, they're equal to the lease payments and any guaranteed residual. And again, this is the fair market value of the transaction. If known, we use the implicit rate. Otherwise, we use the lessor's incremental borrowing rate in calculating the fair market value. Also, at the time of sale, we need to record the cost of goods portion of the entry. We're told the equipment had cost the lessor $220,000, so we record cost of goods sold, an expense of $220,000, and we reduce inventory by $220,000. Again, we're simply treating this as a sale by the lessor. The first payment on the lease is due at the time of signing, so the lessor will receive $54,704 in cash, and every time we receive that amount of cash, we reduce the lease receivable by the amount of the payment. On December 31st, 2020, we have earned interest revenue, and we reduce the lease receivable, or rather increase the lease receivable by the amount of interest revenue. Again, we've effectively at this point in time lent them $185,000 at a 7% interest rate, gives us our interest expense of $12,971. When we receive the payment on January 1st, we record a reduction in our lease receivable and an increase in cash. And again, every time we receive a lease payment, we record a reduction in receivable and an increase in cash. In the next year, we would record interest revenue of $10,049 at year end instead of the $12,000, and we would continue over the 5-year lease life. Now we're going to assume the equipment has a useful life of 10 years with no residual value, and since the lease is for 5 years, and we'll also assume it doesn't meet any of the other 5 criteria for classifying a lease as a financing lease. In other words, transfer of ownership, there is none. We're assuming there's no purchase option at the end. The lease term is greater than 75% of the asset's useful life, and we'll also assume that the present value test is met as well, or isn't met as well. So we're assuming that none of these items are met and that this lease is properly classified as an operating lease. What entries do we make? Upon the signing the lease, again, we record a lease liability and a rights of use asset equal to the present value of future lease payments, which we were told is $240,000. We're making our first lease payment on January 1. And again, whenever we make a lease payment, we reduce the lease liability and we credit cash. On December 31st, a year has gone by. We need to record lease expense. The lease expense will always equal the lease payment. So every 5 years over the term of this operating lease, we will record $54,704 in lease expense. The interest portion of the lease expense will come from our amortization table, the $12,971. That will be the reduction in the lease liability related to the interest portion of our lease, and it will decrease over time. The remaining portion of our lease expense is comprised of a reduction in the rights of use assets and amortization. And again, the reduction in our lease liability will come from the interest column in our amortization table, and the rights of use asset will come from the principal portion of our lease table. And we're making that same entry throughout the life of the lease. And of course, as always, when we make a payment, we reduce cash and we reduce our lease liability. Let's now take a look at an operating lease from the lessor's perspective. Again, we're assuming that the lease does not meet any of the 5 tests to classify it as a financing lease. Notice also we don't have an amortization table because from the lessor's perspective, there's no interest income. We will simply be recording rental income or lease revenue. Let's go ahead. Upon the signing of the lease, the lessor does not record a lease asset or a lease liability. But upon the signing of the lease, Sunland does pay us the first lease payment of $54,704. We have not yet done anything to earn that, so we will record the $54,704 as cash and $54,704 as unearned revenue because we have not provided rental of that asset for any period of time yet. Over time, we will earn that lease payment. Let's take a look at the year-end journal entries at 12/31/2020. At year-end, we've recorded, or rather we've earned, the first year's worth of lease revenue. So we'll credit lease revenue for $54,700 and debit our unearned revenue for $54,700. Also on December 31st, 2020, we need to record depreciation expense. We will record depreciation expense of $22,000 in this case. We were told our asset cost us $220,000 and we'll spread that cost over a 10-year life. And we credit accumulated depreciation. On January 1, 2021, we receive another rent payment in advance. So we will debit cash for $54,704 and once again record unearned revenue of $54,704.